Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields nearing the 3% level. Again, don't forget, not too long ago we were trading just above 310. Then the whole crisis in Italy, we had some other geopolitical risks start to fly around up in the air, and we traded 10-year notes all the way down below 280. Then we kind of made a home right around 290, 293. And now we're starting to see that elevate a little bit, seeing the bearishness come back into the market, refocusing, shall we say, on what is important, and that is Fed meeting week after, June 12th, 13th, and 14th. And then we have ECB, BOJ, we've got inflation. There are a number of things. We got the summit with North Korea. A lot of things coming out next week, not this week, and that is why the market is now refocusing. Italy, no longer a problem. Now focus on what's really key and happening, and that is, I think, the rates moving higher when the Fed raises rates at June FOMC, and seeing how their second half year projections and expectations may shift a little bit, as we've had some pretty good jobs data, inflation slowly creeping higher, wages slowly creeping higher, and seeing how the Fed treats that. That will all lead to higher yields. And if you look at implied volatility in the market, yeah, it's been nosediving. Why? Because, well, higher yields is where the market wants to be. The leverage funds and leverage funds community, the hedge fund community, has been short for quite some time, near record levels. So as we trade, as bond prices go down, as yields go up, it tends to go with the trend. That's what they want. So we get that sigh of relief. The trade of pain is, and clearly was seen last week as, lower yields and higher prices. And we quickly saw volatility bid and quickly saw it come back down. So that's why we're seeing volatility come down, despite the fact that we are creeping back towards the key 3%, likely through it before the end of the week. And that takes us to the last point here. It is a lackluster week. The week after employment, we didn't really have any major news events. There haven't been anything out of left field that would have really caused the market to cringe or reverse course. And I think that right now all eyes are focused on next week, which will start with the North Korean summit. Has a June FOMC meeting. You've got CPI and PPI inflation. You've got ECB and BOJ meeting. A lot going on next week for the market to digest, not to mention auctions. So there's a tremendous amount of information coming out, some of which are more important than others. I think clearly the summit with North Korea is big. I think that the June FOMC meeting is bigger. And ultimately, we'll look at see in the wake of June FOMC what happens with the BOJ and the ECB. But I think ultimately it's those second half projections of forward guidance, dots, press conference we get after the Fed meeting, which will give us a clear signal, I think, on the second half of this year. I don't think that Chair Powell wants to go into the second half of the year with much uncertainty. Whether he says it's going to be 3 or 4 rate hikes in total in 2018 has yet to be seen, but I think that he's going to put some benchmarks that say, if here, then we go 4, if here, then we go 3, and that gives us something to hang our hat on. So right now, bond market creeping back into that old range, volatility lower as we await June FOMC. This is Todd Colvin coming to you from the floor of the CME Group.